Howdy, y'all. Welcome to the Liberty Call. It is Wednesday, November 2nd, 2022. Hope everybody's having a good day out there. Pretty volatile day in the markets. The market started off down and then it went up for quite a bit. And then at the end of Jay Powell talking on the TV, it went right back down again. So no telling, where things are headed, long term. But, he did hint that possibly they could slow things down. But again, I'm not getting too far into that at this point. So, all right, well, let's go ahead and jump in and take a look and see how the indexes did today. The Dow Jones was down 1.55%, closed at 32,146. The S&P 500 was down 2.52%, closed at 3758. NASDAQ down 3.36, closed at 10,524. Small caps were down 3.6. The VIX was up 0.35. It's currently at 2590. Canada finished the day down 1.23. Brazil was up 0.77. Mexico up 1.89. Over in Europe, Germany down 0.61. UK down 0.58. France down 0.81. Euro stocks down 0.79. Netherlands down 0.9. Spain down 0.38. Italy basically flat at up 0.03. Switzerland up 0.21. And Portugal down 1.16. Both Russian exchanges were in the red. MOEX down 0.02, RTSI down 0.85. And looks like the Asian markets were mostly green. Japan was down 0.06, Australia up 0.14, New Zealand down 0.78. All the Chinese markets were in the green. The Shanghai was up 1.15, the SESE component up 1.33, China A50 up 1.03, DJ Shanghai up 1.18. Hang Seng up 2.41, and the Taiwan weighted was up 0.48. So looks like all in all, not the worst day, but again, I think people kind of are freaking out about what's going to happen with the Fed, and when are they going to stop or slow down their rate increases? All right, well, let's go ahead and read through today's market recap. Let's see here. S&P 500 in volatile trade as Powell pushes back against Fed pause. The S&P 500 swung between gains and losses Wednesday as the Federal Reserve lifted interest rates for the fourth time in a row. The Fed raised its benchmark rate to 0.75% and suggested that future hikes will face a higher threshold. But Fed Chairman Jerome Powell pushed back against the idea of a Fed pause, which for now is probably a good thing. That's why the markets are reacting so badly. Quote, it's premature to be thinking about pausing, Powell said in a press conference on Wednesday. Quote, we have a ways to go. The Fed chief added, though he did tee up the idea of slowing the pace of rate hikes at future meetings. The somewhat hawkish remarks from Powell cooled the earlier optimism following the release of the monetary policy, which has, quote, changed significantly, end quote, from the prior statement, Stifel said in a note, adding that it was a clear signal that wave of 75 basis point hikes is over, end quote. Treasury yields remained in the red, but moved off session lows, putting pressure on rate-sensitive sectors, including tech. Apple, Alphabet, and Microsoft were down more than 1%, while Amazon slipped nearly 3%. Semiconductor stocks were also pushed lower as AMD gave up some gains after reporting quarterly results and guidance that missed analysts' expectations. Airbnb, meanwhile, fell more than 10% as fourth quarter guidance that fell just short of estimates overshadowed quarterly results that beat on the bottom line. So, not the best day. Let's go ahead and read through a quick article here about Fed lifts rates by 0.75%, hints at higher bar for future hikes. The Federal Reserve raised interest rates by 0.75 percentage point on Wednesday for the fourth time in a row, and the central bank said the pace of future hikes will be determined by the impact of its previous actions, hinting at a higher bar for future monetary policy tightening. The FOMC raised its benchmark rate to a range of 3.75 to 4% from 3 to 3.25 previously. The latest hike moved the Fed's benchmark rate closer to levels that many believe are close to peak, or the so-called terminal rate. The Fed's latest projections released at the September meeting showed the central bank members favored lifting rates to 4.4 by the end of the year and to a peak of about 4.6 next year in 2023. So we shall see. Inflation is still above 8, so we'll see if that actually slows things down. All right, one last article here. Has to do with I-bonds. U.S. Treasury sweetens the pot on I-bonds by adding a fixed rate. After record-breaking sales of I-bonds in October, the U.S. Treasury is dangling another good deal in front of savers for the next 6 months, starting November 2nd when I-bonds will be available again after site maintenance at treasurydirect.gov. The inflation-adjusted annualized rate will be 6.48, down from the 9.62, but there will also be a 0.4% fixed rate a bump from 0, which where it's been since 2020. The combined rate will be annualized at 6.89, available through April. The fixed rate at the time of the purchase will stay with the I-bond for as long as you hold it, up to 30 years, but the inflation adjustment resets every 6 months in November and May. So that's some good news for those of you who've maybe been purchasing those. And, a little bit of a fixed rate is never a bad thing. So, all right, well, that's everything I had for today. Pretty quick video since, basically all the news was taken up by the Fed and what was going on there, and going to need to read through a lot more articles to digest what's truly going on there. So I'll keep this one brief. I hope everyone has a fantastic evening, and I'll be back tomorrow. So have a good night. Bye-bye.